Commodities are a part of our everyday lives. Traditional commodities are the raw materials we put into other products we use in practically every area of our lives without a second thought. The more traditional commodities fit broadly into the areas of agriculture, energy, livestock, and metals. In the mornings when we get up and get dressed, we may use the commodity of cotton when we pull on our t-shirts, or the commodity of gold and silver when we dress in our jewelry. At breakfast, we consume the commodities of oats, wheat, coffee and sugar through the products that we buy. And we cook breakfast using the natural gas piped into our home through our energy supplier. Mum and Dad Carter are sophisticated long-term investors in equities and bonds. They've been mulling over adding commodities to their portfolio to enhance their returns and to smooth out volatility in their portfolio. Mum and Dad Carter can invest in commodities in a number of ways. They can invest directly, but that limits them to materials they can physically store. Or they could trade in commodities through future contracts. This gives an investor with the right know-how exposure to commodity prices through the futures markets. Futures contracts are financial contracts that buy specific quantities of a commodity at a specific price and delivered at a specific date in the future. These financial contracts fall into the derivatives category and are obligations to buy the underlying asset. The prices of these contracts are based on the underlying commodities and are often used by speculators who believe the commodity price will move in a specific direction. Small movements can result in very big gains or losses. There are many risks that can make your investment go wrong. Mum and Dad Carter, while confident in their investing abilities, thinks it all sounds a bit complex and risky. The other option our investing duo can consider to gain greater profit, that doesn't require them to purchase underlying assets, is another derivative instrument called CFD trading, which means contract for difference. This is essentially an agreement between two parties to exchange the differences between the opening and closing price of a contract. CFDs allow Mum and Dad to use leverage. This is added flexibility because they must only pay a fraction of the total value up front. So while they have the opportunity to maximize their gains, equally, they can also have greater losses than the amount they put in initially. Plus, Mum and Dad should take into consideration not only the interest charged daily, but also any commission and financing charges for transactions from the broker. They don't have to do the high-stakes game of the futures market. They could, for example, buy shares in companies that are engaged in producing and extracting commodities such as oil companies, cereal manufacturers, or mining. Another option is to leave it to the professionals through the diversity of a pooled investment club that manages trading in futures on behalf of its members for a fee. They could also use the exchange-traded funds, or mutual funds, that follow one or more commodity. The fund manager of these funds allocates funds into each commodity and buys future contracts. This may seem dull, but for the Carters, it means more time spent with the kids. Remember, trading involves high risks and can generate substantial losses.